Welcome back to the deep dive. So, we got a request from you, our listener, that we found really interesting.
Yeah. What was it?
You asked us to basically cut through the complexity of a recent official report from a major company. You know, the type dense, legalistic.
Ah, the 10K filing. Got it. They're definitely not light reading.
Exactly. So that's our source today. Specific bits from this company's 10K filed for the year ending December 31st, 2024.
Okay. So this is the company's official word on, well, everything. Their business, financials, risks, all required reporting.
Precisely. Our mission here is to unpack this thing, pull out the key insights, and help you understand what this latest report really tells us.
And it's a big company we're talking about. The filing mentions something like $550 billion market value for non-affiliate stock back in June 24.
Yeah, and over 125,000 employees at the end of last year. Huge scale.
Right. So think of this deep dive as your shortcut through that dense document. We'll cover products, operations, money, challenges, all based on what they reported.
Okay, let's jump in. Where do they start? What's the core mission stated in the filing?
It's ambitious. They state their purpose is accelerating the world's transition to sustainable energy. That really sets the tone.
And how does the report say they're actually doing that?
It breaks it down into two main segments: automotive, which is what most people think of, and energy generation and storage.
Okay, let's start with automotive then. What vehicles are listed in the filing?
They cover the current lineup: Cybertruck, Semi-Model S, Model X, Model 3, Model Y.
The familiar names.
Right. And they also mention planned vehicles for new markets. So still expanding the range.
And the technology inside those cars, what do they highlight?
A big focus is their powertrain tectum, the motors and systems. They stress it's proprietary, efficient, adaptable, like for dual or even triple motor setups.
And the batteries, obviously crucial.
Absolutely critical. The filing talks about deep R&D in cells, packs, systems, the chemistry, everything. They're pushing their own proprietary cell development.
Why? For what goal?
Higher energy density, lower costs, and crucially, securing enough battery supply for their massive production growth plans.
Okay, makes sense. What about software? That seems like a big differentiator for them.
It really is. The report emphasizes their in-house software development: vehicle control, safety, battery management, infotainment. They do almost all of it themselves.
Which allows for those over-the-air updates we hear about.
Exactly. Regular, consistent updates delivered wirelessly. It's a core capability they highlight.
Now let's get into some of the, let's say, more advanced stuff mentioned. FSD, supervised.
Yes, that's in there.
Yeah.
They talk about leveraging the FSD supervised features, which includes what's called FSD capability elsewhere.
But the key is the supervised part, right?
Definitely. The filing and the name itself stress that a human driver absolutely must remain fully attentive and engaged. That hasn't changed.
But they are looking beyond that, towards full autonomy.
Oh, yes. The filing details plans for a purpose-built robotaxi product. They've even named it Cybercab.
Cybercab. And when might we see that?
The report states their intention is to start launching a robotaxi business in 2025. The ultimate aim is operating fully autonomous vehicles.
And AI is key to that, presumably.
Hugely. They mention their AI capabilities, specifically citing their big Cortex training cluster down in Texas as a major advantage for achieving this.
Interesting. And is that AI tech only for cars?
No, the filing explicitly says they're leveraging the AI advancements from self-driving for robotics. They mention Optimus, the humanoid robot project,
Ah, yes, Optimus.
and confirm it's controlled by the same AI system that powers the self-driving features. So a shared AI foundation.
Okay, shifting gears slightly. Charging infrastructure, the supercharger network.
Yep, it's covered. They talk about the growing global network, industrial-grade, high-speed chargers placed strategically.
And they try to make them sustainable, too.
They mention efforts to co-locate charging stations with solar and energy storage where possible. Helps with costs and fits the sustainable energy mission.
And that big move a couple of years back, opening up their charging plug standard.
Right, the North American Charging Standard, or NAACS. Now it's formally SAE J3400. The filing highlights this as a key step,
Why? What was the impact they point to?
making charging easier, more interoperable between different EVs and chargers. They see it as directly advancing that core mission of sustainable energy transition for everyone.
And other automakers jumped on board, didn't they?
Almost all major ones, yeah.
Yeah.
Announced adoption with access starting in 2024 and cars with a plug coming in 2025. Big shift.
Okay, let's pivot to that second business segment, energy generation and storage. What products fall under that umbrella, according to the report?
It lists residential solar, both retrofit systems and their solar roof product, the one with integrated solar
I'll
tiles,
write the glass tiles.
and then energy storage, Powerwall for homes, and the big megapack systems for utility-scale projects.
I assume there's some tech overlap with the vehicles here.
Definitely. The report says they leverage component-level tech from vehicles for storage, things like power electronics, which are crucial for both cars and grid connection.
Makes sense. Anything else on the energy product design?
They mention a modular design approach for storage to help with manufacturing, and also integrated systems like how Solar Roof and their inverter are designed to work directly with Powerwall.
And software plays a role here too?
Yes, software for remote control and dispatch of the energy storage systems is highlighted.
Did they give any numbers on how much storage they deployed last year?
They did. The filing states 31.4 gigawatt hours deployed in 2024.
Wow. And just for context, how big is a GWA?
It's massive.
Yeah.
Enough energy storage capacity to power, hundreds of thousands of homes for a bit or support large industrial needs. So 31.4 gigawatt in 1 year. That's significant volume.
Okay, so that's what they make. How does the filing describe how they operate and grow? Sounds like they do a lot themselves.
Very much so. They emphasize extensive in-house capabilities, design, engineering, manufacturing across both automotive and energy.
Like what specifically?
Advanced CAD simulations. They even mention their unique approach of integrating the battery pack into the vehicle structure. That's complex engineering aimed at efficiency and cost.
And for energy.
Similar depth, electrical, mechanical, civil, software engineering for designing and installing those systems.
And manufacturing is obviously huge for them. Gigafactories, megafactories.
Absolutely central. The filing lists their global sites: California, New York, Texas, Nevada, Germany, China. And they state a core principle: build each new factory better, more efficiently, more sustainably than the last one.
Are they tailoring production for different regions?
Yes, the report mentions localization, adapting vehicle designs, and manufacturing for specific markets and workforces. They also talk about using simulation heavily to optimize automation and line building before they even break ground.
What's driving the next phase of growth according to the filing? What are they focusing on?
It's linked directly to progress and autonomy, new products like whatever is coming on their next-gen platform, and critically scaling up battery cell supply.
Including making their own cells.
Yes. Manufacturing their own cells designed for high volume, lower cost, and better range is explicitly mentioned as part of this next phase. The overall goals: better performance, much lower production costs, and ultimately making products more affordable and accessible.
And pulling all that off globally, it must take serious resources.
The filing is very clear on that. Ramping up sales, deliveries, installations, service, charging. It all requires huge cash investments and intense management focus. No small feat.
Let's talk about the people making it happen. The report has a whole section on human capital resources, right?
It does. They position attracting, developing, and keeping talent as a key competitive edge. Remember that headcount? Over 125,000 people globally, end of 2024.
What about benefits? What do they highlight?
They describe them as industry-leading. Things like free counseling, paid parental leave, 401k, zero-cost fertility and adoption support, and zero premium medical coverage from day one are mentioned.
And stock options.
Stock ownership opportunities offered to 92% of employees, according to the filing.
They also seem to emphasize growing careers from within.
Very strongly. The report states over 13,000 employees advanced internally worldwide in 2024. Impressively, 80% of those were from the frontline workforce.
Wow. And management promotions too.
Yeah, 68% of managers promoted from within, and 45% of their managers have been with the company for 5 years or more. Suggests some stability there.
Are there specific programs mentioned to support this internal development?
Quite a few, actually. An education assistance program launched early 24, tuition-free or funded degree certificates in relevant fields like manufacturing, AI. Thousands apparently enrolled or graduated already.
Okay. Anything else?
Yeah. Tailored training in Europe, global apprenticeships for skilled trades, a technician trainee program for service and collision roles, and even a pilot rotational traineeship in the UK, Ireland. It paints a picture of significant investment in skills development.
So a lot on training and development. What about company culture and safety?
The filing mentions fostering a connected experience, enabling performance, recognition, the usual culture pillars. On safety, they report a continued drop in incidents per vehicle produced, even as volumes ramp up.
And workplace conduct.
They detail a zero-tolerance policy for harassment, discrimination, etc., backed by mandatory training. Their engagement strategy is described as listen, act, report back. citing an 86% participation rate in their Pulse survey.
Who keeps an eye on all this people strategy at the board level?
The filing says the Compensation Committee oversees the human capital strategy, getting regular updates from HR, legal, and compliance.
Okay, big shift now. Let's talk money. What did the 10K report for their 2024 financials? Top line numbers.
Total revenues for 2024 came in at $97.69 billion. That was actually just a slight increase, about 1% from 2023.
Only 1%. Okay. And net income, profit.
Net income was $7.09 billion, but that was a pretty significant drop compared to 2023.
Hold on. Revenue basically flat, but profit dropped significantly. How does the filing explain that?
Yeah, it seems counterintuitive, but there's a specific reason highlighted in the report. It wasn't really about 2024 operations being less profitable. The big factor was a one-off accounting event in 2023.
Okay. What happened in 2023?
In late 2023, they released a massive tax asset valuation allowance worth about $6.5 billion. It basically artificially inflated the 2023 net income number. So the 2024 profit, while lower on paper, might be a cleaner look at the underlying operational results for that year.
Ah, I see. That makes more sense. So let's dig into the revenue streams for 2024 versus 2023. Automotive first.
Right. Total automotive revenues actually decreased by 6%, dropped from over $82 billion down to just over $77 billion.
Why the drop?
The filing points mainly to lower average selling prices, think price cuts, financing deals, and also changes in the mix of vehicles sold. Specifically, they delivered about 22,000 fewer Model 3s and Ys combined.
Was that offset at all?
Partially. Deliveries of other models increased by about 19,000, which the report says was mostly the Cybertruck starting its production ramp, but not enough to cover the drop from 3Y ASPs.
So the main car revenue was down. Were there any positives within the automotive segment revenue?
Yes, a couple of notable ones. Revenue from selling regulatory credits jumped significantly, up 54% to $2.76 billion.
Wow, that's a lot.
It is. And they also recognized $596 million in deferred revenue related to FSD supervised features being released during 2024. So that's starting to hit the income statement.
Okay. How about the services and other revenue line?
That showed really strong growth, up 27% from around $8.3 billion to $10.5 billion.
What drove that?
The filing attributes it to growth in used vehicle sales, their insurance business, more paid supercharging use, and just higher volumes of parts, maintenance, and collision repairs. Kind of the ecosystem around the cars growing.
And the energy segment, we heard deployments were up. Did revenue follow?
Big time. Energy generation and storage revenue was the star performer in terms of growth rate, up a massive 67% from about $6 billion in 2023 to over $10 billion in 2024.
And the reasons given?
Pretty straightforward. Ramping up production volumes, introducing new things like Powerwall 3 and getting those big mega factories in Shanghai and Lathrop, California really humming. Clear momentum there.
Okay, revenue picture is clearer. What about profitability on those segments? Gross margins.
Automotive gross margin dipped slightly, from 19.4% in 2023 down to 18.4% in 2024.
Same reasons as the revenue drop.
Basically, yeah. Lower average selling prices, the initial costs of ramping Cybertruck, though they say lower manufacturing costs per unit on other models, and those high-margin regulatory credits and FSD revenue help offset it somewhat. Total automotive plus services margin also fell a bit.
But the energy segment must have improved its profitability with that revenue jump.
Hugely. Energy gross profit more than doubled, went from $1.1 billion in 2023 to $2.6 billion in 2024. So as that segment scales, it's becoming much more profitable, according to the numbers.
Interesting. The filing also mentioned something called other income expense net having a big swing.
Yeah, that line item jumped dramatically, up over 300% to $695 million in income for 2024.
What was behind that?
Primarily foreign exchange gains, but also gains from remeasuring their digital assets. That digital asset piece is linked to adopting a new accounting standard in early 2024 that changed how they value those holdings.
Got it. Let's talk cash. How did the cash flow look for 2024?
Okay, cash from operations was strong, nearly $15 billion generated. So the core business is throwing off cash.
But, sounds like there's a but.
Well, investing activities used a lot of cash, $18.8 billion outflow. The filing says this was mostly buying property and equipment, think factory expansions, machinery, plus other investments.
So spending more on growth than they generated from operations.
In 2024, yes. They funded that gap partly through financing activities, which brought in about $3.8 billion, mainly from issuing debt. So investing heavily in future growth.
Now, the filing also flags certain accounting areas that involve a lot of judgment, right? Areas that could change.
Exactly. They're called critical accounting estimates. Things like inventory valuation, predicting future demand to avoid write-downs. Stock-based compensation is another big one. They had $5.8 billion in total unrecognized expense from stock awards at the end of 2024, which will gradually hit their profit numbers over the next few years.
Any others jump out?
Warranty reserves. Their auditors actually flagged this as a critical audit matter,
Meaning?
meaning it involves significant judgment and uncertainty. Estimating future warranty claims how often things might break on potentially millions of vehicles, especially newer models, and what it costs to fix them is inherently tricky.
How much did they have set aside for that?
$6.7 billion accrued for potential future warranty costs at the end of 2024, mostly for the cars.
Okay. And what about those vehicle leases? Any financial risk there?
Yes, specifically around residual value guarantees. When they sell lease contracts to partners, they sometimes guarantee the car's value at the end of the lease.
And that exposure grew.
Significantly.
Yeah.
Their maximum potential exposure jumped from $166 million at the end of 2023 to $1.45 billion by the end of 2024. Suggests a big increase in leasing activity involving these guarantees.
One last financial item. Uncertain tax positions.
Right. They reported $1.4 billion in gross unrecognized tax benefits. This is basically potential tax liabilities that could emerge if tax authorities disagree with how the company interpreted certain tax rules. Predicting the outcome is difficult, the filing notes.
All right, that covers the internal view operations, people, finances. What does the filing say about the external world? Regulations, competition, risks.
Government actions are a big factor. The U.S. Inflation Reduction Act gets specific mention, the tax credits for EVs, batteries, solar. These help customers and sometimes the company directly.
But they won't last forever.
No. The filing notes, they're scheduled to phase out starting around 2032. They also mention state programs and factory-specific incentives tied to investment and job targets.
What about the regulatory hurdles?
Complex. Standard vehicle safety rules apply, requiring self-certification. But the big challenge highlighted is the evolving, fragmented regulation around self-driving tech. There's no single federal U.S. standard for autonomous vehicles. It's a patchwork of state laws, plus different rules emerging in Europe, China. This can limit features or delay rollouts, the filing warns.
In competition, I imagine it's intense.
The filing is blunt. The auto market is highly competitive and getting more so. Lots of established players and new EV startups are piling in.
Competing on what?
On everything.
Yeah.
Vehicles, but also tech platforms, self-driving, charging, software. And the filing acknowledges many competitors have way more resources.
And energy storage, also competitive.
Yes, similar story. Lots of companies offering similar products, competing on price, energy density, efficiency. Not an easy market.
What about broader economic risks mentioned?
The filing notes the auto industry is cyclical,
Yeah.
sensitive to things like interest rates, inflation, energy prices. They specifically say rising interest rates have hurt vehicle affordability and demand.
Okay, and operational risks, things that could go wrong internally.
A whole list. Supply chain issues are big component shortages, material costs, relying on single suppliers for key parts.
Like battery.
Exactly. Access to battery cells and controlling their cost is flagged as a major risk. It ties into their dependence on suppliers versus the uncertainty around ramping up their own cell manufacturing, plus volatile raw material prices.
What else operationally?
Challenge isn't just executing the expansion. Building factories on time, on budget, hiring skilled people, ramping new products like Cybertruck smoothly. It's all complex and risky. There's also the risk of just missing their own ambitious growth targets for sales or infrastructure.
Maintaining public perception seems to be a concern, too.
Yes, the filing mentions maintaining confidence among customers, investors. The public can be difficult. They cite their shorter history, the uncertainties of rapid growth, intense competition, and sometimes they feel exaggerated or unfounded criticism in public discourse.
We talked about leasing risks financially, but operationally, too.
Yes, related to accurately predicting those residual values and the potential hit if their guarantees are triggered more than expected.
Cyber attacks are always a risk these days.
Definitely mentioned. Vulnerabilities in their systems, vehicles, third-party suppliers. A successful attack could mean data breaches, IP theft, lawsuits, reputation damage. They outline risk management processes and board oversight for this.
And finally, that direct sales model can still cause friction.
Yeah, the filing notes ongoing legal and regulatory challenges in some U.S. states where dealer franchise laws might restrict their direct-to-consumer approach. While they've won battles, dealer associations keep pushing back, potentially limiting where they can open stores or service centers.
Wow. Okay, that really was a deep dive through just this one filing. We covered a lot of ground.
We really did. From the core mission and the two big business arms, auto and energy, to how they build things, the huge workforce, the complex financials,
Right, those revenue shifts, the profit explanation, the big liabilities like warranty and lease guarantee.
and then all those external pressures.
Yeah.
Government incentives, yes, but also
Mhm.
tough regulations, fierce competition, supply chain risks, economic headwinds. It's all in there.
It paints a picture of, well, incredible ambition facing immense challenges, all laid out by the company itself.
Absolutely. High-stakes innovation, global scaling, financial juggling,
Mhm.
all happening at once.
So for you listening, having heard this breakdown based on the company's own report, thinking about the push into autonomy with Cybercab, the crucial battery scale-up, the price pressures versus the energy growth, managing those huge investments and risks, what single element do you think will be the most critical factor for this company's future?
Yeah. What's the linchpin? Is it the tech? Manufacturing,
Hmm.
managing the finances, navigating regulations, competition.
Or how do all those pieces have to fit together perfectly for them to succeed or maybe stumble in the next few years? Something to
Oh,
definitely mull over.
for sure. Lots to think about there.
Indeed. Thanks for joining us for this deep dive today.